And we're hearing from Jerome Powell this week, and he is being taken to task around why aren't you cutting interest rates? Obviously, we know that's what U.S. President Donald Trump would like. And Powell himself seemed to acknowledge, if it weren't for tariffs, maybe we wouldn't be cutting in July. But he does seem to be ruling it out for this summer. What should Powell be doing?
Exactly what he's doing. Exactly what he's doing. So the challenge is this. The Fed has a 2% inflation goal. That's their sort of, we want inflation to be roughly 2% on average over the long term. That degree of price stability is helpful for firms that want to plan, their borrowing, their expenditures. It's helpful for them in setting wage growth over time, right? Compensation plans. And it's helpful for consumers to know that their income now is going to be worth roughly the same next year and the year after and the year after. So the 2% goal is half of their mandate, right? Price stability. But the other half of the Federal Reserve's mandate is maximum employment. And so at this point in time, the Fed is in a very difficult position because, to reach lower inflation, they have had to raise interest rates and they have slowly begun to bring them down, but now they have to pause. And the reason they have to pause, even though inflation has come down considerably, they have to pause because the tariff policy that's being floated by this administration could push up prices in a way that makes those price increases not a one-time, hey, slap on a 30% tariff, this price goes up 30%, but a gradual increase, a little bit of a price increase here. Companies are going to try to wait and see if they can maybe absorb some of that tariff and a little bit lower margin, but maybe they won't, and then they'll raise prices in the future. The point is that tariffs, in theory, cause a one-time change in price level, but in practice are likely to cause higher inflation.